Okay, I'm gonna start. Camera can up a bit or not? So that they don't see my double chin. When you age, your chin sags. The skin below your chin sags down. Is this recorded? Shucks. Yeah, so the camera angle is extremely important because if I'm always like this, people will see this. Oh, it's blocked off everything. Great. That's what happens when you age. Alright, so welcome back to our next episode of Nuggets on the Go. So today we're going to talk about this very interesting topic, which is called the asset inflation, that usually a lot of people do not pay attention to because we only pay attention to what is commonly called the CPI inflation, which is a consumer price inflation or consumer price index or consumer goods inflation. And we usually look at inflation as a year-on-year basis, hovering at around the 1 to 2% kind of mark at the national level. Across different countries also, inflation usually hovers around the single-digit points. So of course, in different countries, sometimes inflation happens very rapidly when the government prints too much money of its own currency. That was being seen in countries in the West, for example, like what happened in Venezuela, where you have seen like a couple of news articles where they talk about, in order to buy just a very simple good, you need to like carry loads of money in order to buy the daily necessity due to the currency supply not being controlled in a certain fashion to protect the currency value. So we want to look at whether is asset inflation happening in Singapore, because in Singapore, I think we are only very focused on what is the inflation level per year based on statistics. If let's say we were to bring out just a very simple, you can just Google inflation in Singapore 2021, and then you're going to see, like, for example, the latest article on Channel News Asia, core inflation up 1.5% in October, but expected to come in around 2% this year and average 1.5 to 2.5% next year. Usually we're always talking about this, just about 2%. So does that apply to real estate? Because that's a very important question and an important fact that we need to find out. Because it's very important to distinguish, does real estate actually follow the national level of inflation percentage? Definitely the answer is no. Because our inflation level, when we look at the national level, it does not include transportation and it does not include real estate prices. It does not include accommodation. So you can actually go in depth to look at in Singapore, what are the factors relating to the 2% average inflation that we have always been talking about, and realize that transportation and housing is not inside. And we're going to look at what has happened to the asset prices over the past 3 years, starting from 2019 to 2020 and then to 2021. These 3 years has been interesting, especially after the onset of the pandemic. We're going to look at 3 particular districts today: District 5, District 15, District 19, and we're going to look at 3 different types of properties: HDB apartments, landed properties, as well as condos and apartments in these 3 different districts. So later we're going to bring out the charts. But in the meantime, let's have a look at some of the very unique characteristics of real estate as an asset. This is a slide that I always shared during our class in assembly at PLB. So at PropertyLimbrothers, we have this academy that is called Assembly. Right now, it's not open to the public yet, but in 2022, very likely we'll be opening up to the public. We're going to have some very interesting investment courses as well. But right now, it's only for all our PLB teammates. Real estate has a very interesting set of inherent characteristics that not all other assets have it all. So other assets might have some of the inherent characteristics that real estate have, but they do not have it all. And let's have a look at what are 8 characteristics. So basically, the very first one will be leveraging. And real estate is one of the very rare assets that allows you to leverage right from the onstart of purchase. That means that right now in Singapore, if you do not have the full purchasing power to own the entire price of the property that you're going to buy, let's say it's a $2 million property, you don't have to save up to $2 million to acquire the property. All you need to do is 2 things. You must have the first 25% down payment, which is $500,000. You must have the ability to pay the buyer's stamp duty, which is 4% less $15,400. And of course, the third thing is that you must show the bank your ability to repay the monthly installment with your financial earning power right now, whether is it through proof of your monthly income from the salary of the job that you're working right now or through your business reported in your NOA per year. That leveraging is unique in real estate because in Singapore, LTV is 75%, 25% down payment. So basically with 25% down payment, you can own the property based on your TDSR capability. Second thing is that real estate, of course, is a physical asset that allows you to generate income through the vehicle of rental. So you can purchase property as a real estate rental investment. You can purchase property. Of course, you can do co-living, which is like very popular right now. This is an income generating asset. Number three, it also has capital appreciation power. But number three is being linked to number four because not only does real estate enjoys the core inflation that we are talking about, which is like 2% per annum, and compounding over 30 years, the amount of compounding power of the CPI inflation is also very powerful. On top of CPI inflation, you have asset inflation as well, which we're going to talk about asset inflation. Asset inflation is very linked to the inflationary environment that we are in right now in our economy. We're going to talk more about that, and that's relating to quantitative easing, the printing of money. And next, and point number five is that you have usability quotient. That means anytime if you want to move in, you want to use the asset, you can live in it, you can use it, or you can do creative things with it. For example, we have customers that buy a 3-bedder, they are young professionals, young adult, they live in the master room and rent out the 2 other bedrooms to supplement the monthly installment. So there's a lot of flexible usage on how you want to utilize the property. That's what we call usability quotient. And of course, you can do equity term loan. And that is an additional option that you have without selling off the asset. So let's say if your asset is performing well, you do not need to kill the golden goose. You can basically do an equity term loan, extract capital out of the property, and then use the capital for other usage, maybe in your business or maybe other forms of investment. The very unique thing is that when you leverage from the bank, when you loan from the bank towards the mortgage, and if your property appreciates in price, your bank that loans you the money for the mortgage, they do not need to share your profit. So for example, let me bring out this illustration here. For example, if you to buy a property at $2 million, you put in $500,000 as 25% down payment, the bank put in 75%. Of course, why the bank is willing to loan you is because you have proven your ability to pay them back potentially with your monthly income and your earning power over the loan tenure, whether is it 20, 25, 30 years. And the calculation is that you take 65 years less off your age. Max tenure is at 30 years at the point of purchase. And of course, the third component is that the banks is willing to loan you because real estate is a physical collateral that they can actually confiscate if, let's say, after 3 months, you are unable to service the monthly installment back to them. So they can actually take your property from you if you do not have the financial capability to continue holding that property. So they can take the property, they can auction it off in order to recover their mortgage. And of course, that comes in conjunction with them earning the interest from the loan that they're giving you over the tenure period. Of course, right now, interest rate is at all-time low, right now is about 1.1, 1.2%, depending on what kind of purchase package that you take. You repay the bank every month through monthly installment, and that's separated into 2 components, principal and interest. Interest is the interest that the bank earns. Principal is something that you put into the property, and the principal will be released back to you when you eventually sell the property or you perform an equity term loan. That's another story altogether. But let's take, for example, after 3 years, if this property appreciates from $2 million in the year 2021 to the year 2024, and it becomes $2.5 million, that appreciation of 500,000, the banks do not need to share that paper gain with you. Meaning that whether your property appreciates or depreciates, they have no interest in your gain or your loss. They basically just want to earn the interest, and they want to recover the mortgage that they initially loan you through monthly servicing of the principal and the interest through the monthly installment back to the bank. That paper gain is something for you to keep. So let's say after 3 years in 2024, you decide to sell the property. What is going to happen is that you put in $500,000, you loan $1.5 million from the bank. 3 years later, let's say you have serviced $100,000 from the mortgage, and you need to pay off your balance mortgage, which is at $1.4 million. The bank just need that $1.4 million to be repaid back to them. And when you sell off at $2.5 million, you less off $1.4 million, you will then take back $1.1 million. So how did your $500,000 then became $1.1 million? Is because there's a $500,000 paper gain, plus you have already paid down the mortgage with $100,000 $20,000 contributing towards the principal payment. We're not calculating the interest payments that is also part of the picture, because maybe in totality over the 3 years you have paid off $120,000. 20,000 is the bank's interest, 100,000 goes to the principal. But for this illustration, I hope that you can be able to visualize that to bring up point number 7, that the bank do not need to share your profit. This is very different if, let's say, for example, you're running a business and then an investor want to invest in your business and they say that, hey, I value a business at $2 million. I want to pump in $1.5 million. I want to own 75% of your business. You retain 25% of your business. And then 3 years later, when the valuation of a business appreciates to $2.5 million, definitely your investor is going to want 75% of that gain, which is $400,000. So the $500,000 appreciation, your investor will definitely own 400,000, you will own 100,000. So this is very different from investments outside, because this is one unique thing that real estate have. And of course, point number 8 is a double-edged sword, because real estate is a physical asset. It is also illiquid in nature. So in other countries whereby there's no cooling measures, for example, unless you are able to buy a real estate today, you are able to sell it 1 month later or even tomorrow, the shorter the time span and the lesser the restriction that is bounding you to immediately enter and exit the property, the more liquid is the asset. However, in Singapore, if you talk about residential property, they are mostly illiquid by a matter of 3 years, because the moment you buy, you will need to hold it for 3 years, because if you sell within 3 years, you can still sell, but you'll be taxed very heavily with the seller stamp duty of 4%, 8%, and 12% over the balance 1, 2, 3 years period. So to recap on seller stamp duty, if I buy a residential property today, and let's say within the first year of owning that property, I decide to sell, I can sell, but I need to pay 12% of the selling price to IRAS, to the government. And of course, if I sell within second year, I need to pay back 8%, third year 4%, fourth year onwards, if I sell, there's no tax, there's no seller stamp duty. In Singapore, residential property is illiquid and bounded by 3 years. I would say that it has an illiquidity of about 3 years. But if we talk about commercial property, then it's different. Commercial property is more liquid because it has lesser restriction. There's no seller stamp duty bounded. You can buy today, you can sell tomorrow. But back to the nature of real estate itself, because it's a huge quantum product, it is a physical asset as well. The illiquidity is also bounded by the transaction period, because let's say if you want to now decide to sell off your property, you need to pre-prep your property, you need to market your property, you need to find a broker, you need to have marketing campaigns, you need to allow for months for people to come physically to view the place or view the video and things like that. And then once the buyer puts in an offer after negotiation, the entire marketing period might already take 3 months. And then to complete the transaction, it will then take maybe another 3.5 months. So all in all, there's also an additional of about 3 to 6 months kind of illiquidity on exiting the property. Coming back to the purchase, there's also illiquidity with purchasing the property, because to complete the transaction, it also take about 3 over months. So this is what we call illiquidity in nature. However, because of the illiquidity nature of real estate, it also has very low volatility. So illiquidity is also in relationship to volatility. And the more illiquid actually the real estate is, and actually the seller stamp duty is a fantastic kind of cooling measure that came out. Because of seller stamp duty, the residential real estate became more stable. And because that removes the speculation portion of it, people are not able to buy and immediately sell after 3 months. And thus it becomes more stable. The growth becomes more constant. This increases the factor that it became more and more like a safe haven, especially when we talk about Singapore residential property in nature. So that's the 8 inherent characteristics that we talk about. And for today's episode, we want to zoom into this thing called the asset inflation. Asset inflation is a very interesting topic. And later on, we're going to show you this graph over 3 different districts. We're also going to show you in combination the 3 districts on over HDB, landed and condo. We will be able to see how much each type of property in these 3 districts has appreciated in terms of asset inflation over these 3 years. And definitely, it's so much more than the core inflation that we are talking about on a national level. Now, let's have a look at this portion here. Now, asset inflation has a lot to do with this. So if we look at this explanation here, the consumer price index, which is one of the most common measure of inflation, is a very commonly used tool that we look at inflation in Singapore. Now, of course, CPI does not measure the cost of everything in the economy. It is a fixed basket of goods and services commonly consumed by resident households. The measure of this seems the most relevant since everyone, regardless of his or her profile, is a consumer. However, if if you go into the fixed basket of goods and services, you'll find that property is not in it. What happened was that in March 23rd, 2020, there was an article that shows that Fed in US actually is starting unlimited QE. Of course, in recent news, there was a tapering of QE, but tapering doesn't mean a total stop. And thus, when you look at the effect of the quantitative easing in terms of increasing money supply, in the US money supply, it has increased tremendously over the past 18 months. And this is basically the United States money supply M2. You can see like a sharp jump over here. But when you look at what has then happened in Singapore, there was also a sharp jump here as well, all the way from 2020 until today. And this is what we call the increase in money supply. So basically, when we look at a very simple example, let's say a country is just this island with 100 properties over there in this island called Singapore, for example. And if money supply increases, it means that there's more money in circulation in the system. If the real estate remains constant in terms of the amount of supply of real estate and money supply increases in quantity, what is going to happen to the real estate prices? Firstly, this increase will seep into the market through the stock market, through the bonds market, and of course, it will end up in the hands of consumers, it will end up in the hands of companies, it will end up in the hands of investors. And when investors has that additional amount of bandwidth to invest, what is going to happen to the demand of real estate? Because real estate is an asset that is seen as a safe haven. The natural behavior of human beings is that when I lock in my profits through a gain in, let's say, the stock market, naturally, because stock market is more volatile, it goes ups and down. It is very reactive to news. The trading transaction speed is very fast. I can enter, exit quickly. Naturally, sometimes the natural human behavior is that I want to lock in my profits. I want to pump that gain that I already have into a more illiquid asset, which is an asset with a lesser volatility. And real estate, of course, through the years is a proven asset class that a lot of people will actually park their capital within this asset for the purpose of either staying in it or for the purpose of renting out or for different kind of usage. And at the base level, this is something that people want to park their capital in to protect the capital. And inflation on the real estate also happens because construction cost increases, manpower costing increases, material used to build real estate increases, land prices also increases. So there's various components working into the inflation quotient of real estate as an asset class by itself. But most importantly is that when we look at this real versus nominal value, and these are extracted from Wikipedia, we need to look at the definition of real and nominal value because we're just so used to inflation that sometimes we forgot about this. What do we mean by real and nominal value? Now, nominal value is measured in terms of money. For example, if let's say you have $100,000 in savings in your bank right now, 10 years later, the $100,000 is still called $100,000. So when you go to your bank account, the $100,000 is still there. That's the nominal value. However, the real value will deflate because we are in an inflationary environment, meaning that when you hold cash and you do nothing with cash, what is going to happen is that this $100,000 in 2021 is going to buy you lesser goods and services in 2031, which is why our parents always say that, hey, for example, my parents, when they bought their 4-room BTO 30 over years ago, about 35 years back when I was like 5 years old, before they shifted from the kampong, they bought the 4-room flat for, I think, about, $30,000 or something. And then how much is their 4-room flat right now, even though it's, the HDB apartment has a balances of like 60 over years, is easily worth $500,000 when we look at the current value. So it's $30,000 to $500,000 in the 35 years bandwidth, even though the property is depreciating in terms of the balance tenure. Why is that so? It's because there's two types of inflation working into it. One is the CPI inflation. One is the asset inflation that happens. And that is what we mean. So using this example of my parents' property, if you were to have $30,000 sitting in your bank 35 years ago, and now after 35 years in 2021, you open up your $30,000, you could have bought a HDB apartment back then from the government, but you didn't do so. And right now, 35 years later, this $30,000 cannot buy you any property already. So that's an example of real versus nominal value. And why is that important? Is because in an inflationary environment where quantitative easing is allowed, that will mean that anytime when there's an increase in money supply, your cash is going to deflate in terms of real value. The moment money is printed, the moment money supply is increased, your cash in the bank deflates because you are then unable to buy the same goods and services that you could have bought in the past. A very simple example is this year. Just have a look at the car prices right now. Cars are also subjected to inflation because of the fact that when money supply increases, a lot of people have more liquidity on hand. They want to go out and buy big ticket items. They want to buy cars. They want to buy luxury products. And of course, not forgetting, they also want to invest in real estate. That's what happened to the car prices. Just have a look at the increase in price of a Japanese car last year versus this year. Have a look at increase in price in a luxury car last year versus this year. I'm going to just put these two car prices right there. Figures taken from, of course, very popular websites. And that has a lot to do with 1971, where US no longer peg a US $1 to US $1 because basically the gold standard was being removed. That actually gave rise to the quantitative easing concept that has been introduced since the past global financial crisis, whether it's 2008, whether it's the latest pandemic, because this is one of the policy that the government will use to save the economy, to save jobs, to save banks, MNCs from crumbling. So this is a tool that naturally some countries will use to save their own economies. So let's have a look. When we look at inflation, the CPI inflation likely will be around 2% this year, but there's this induced asset inflation. We call this a fleet to finding and parking your capital, your liquidity, your cash in assets with a better store of value as your money becomes smaller. So as your money, because you already know inherently that your money becomes smaller in the next 5, 10, 15, 20 years, you want to do something about your money right now. And one of the ways is to park it in an asset that is proven to be a store of value. So of course, there are various different kinds of assets, right? You can invest in good blue chip stocks. You can invest in companies that are performing very well. You can invest in gold. You can invest in certain luxury assets that has proven over time to appreciate. The longer you store, you can invest in collective arts. And of course, now there's like NFTs and all that. The various other forms of investments will leave it up to you. But of course, when we talk about real estate, it has already proven over so many years to be a great store of value. And when we look at this behavior, when M2 money supply happens, and that created more induced asset inflation, because everybody is now trying to store their capital, the excess liquidity, maybe it's gains made from the stock market or cryptocurrency, or for example, and they're trying to find what is the next best asset or the safer asset with lesser volatility to store that capital. And thus, that increases the demand of the 100 properties in that island. And what is going to happen to the price of the 100 properties is just naturally going to rise, because when people have more buying power, they're going to bid for the properties. There's going to be more people viewing properties. There's going to be lesser people trying to sell. And naturally, people will pay higher and higher prices for the properties as demand increases. So that is a natural reaction that will happen in the economy. When we look at this, the combination of District 5, District 15, District 19, why did we select these three districts? Because recently we have been talking about these three districts in terms of landed property price performance. And thus we tabulated landed property. We also tabulated HDB. We also tabulated condo properties. In terms of HDB, over the past 3 years from Jan 2019 up to the tail end of 2021, HDB price has moved up by about 6.2% in District 15 HDB apartments. And then for D5, that's a total of about 16.3%. And then in D19, that's a total of about 13.1% in terms of HDB apartments price movement. So in D5 and D19, they are both double-digit growth. In D15, single-digit growth. And then let's have a look at landed properties. So landed properties, District 15 has went up by about 10.1%, and then District 5 21.3%, District 19 total of about 5.7%. And then when we look at the condominium prices, it has went up by about 23.5%. D15 has went up by about 11%. And then D19, it has increased, but is in a more tepid level. And if we were to look at in combination, HDB overall, in total, in these three districts, went up by about 12.8%. Landed properties 10.6%. And then condominium is about 5.7%. So when we look at the percentages of all three categories of properties in these three districts combined, the price inflation over these 3 years definitely supersedes the 2% national level CPI that we are talking about. And this is what we call asset inflation, because it's caused by a surge in terms of money supply that then translated and flowed into the economy. And thus, everybody has more buying power. And when they have more buying power, the asset prices increases because there's more demand. There's various other factors. For example, what's going to happen is, of course, the en bloc season is coming out as well. And and developers land bank are clearing up. And of course, there's a lot of other fundamental reasons. But just by looking at this, a large percentage of this is being caused by the quantitative easing that happened ever since the start of the pandemic. I think it's very important that we need to do some forward planning. And what does forward planning means is that having that awareness that the money that's sitting in the bank, if let's say you have the ability to invest, but let's say you're waiting on the sidelines and let's say you're giving yourself like 3-5 years to invest, no matter what kind of asset that you want to invest in, the first criteria is to note that do you want to invest in an asset that is less volatile or more volatile? Do you want to invest in an asset that is illiquid or more liquid? And I think it's very important to have a balanced portfolio, because if all your equity is in real estate, then your entire portfolio is very, very illiquid in nature. Illiquid in nature means that anytime, let's say you need to use the money for your business, you need some additional funds for your kids' education and stuff like that, but you cannot extract the capital out from real estate very quickly. But of course, you can do that through refinance, equity, term loan and stuff like that. But it's still generally more illiquid than other liquid assets. So I think it's very important to have a balanced portfolio. Real estate definitely as one of your main portfolio. There's so many inherent characteristics. You can live in it, you can rent out, you can generate income and things like that. And you can write on from asset inflation that's being caused by QE. You can also write on CPI inflation. But the kicker is that it's very important to note that when you go into real estate, you must have the financial capability to service your monthly mortgage. Because if you do not have the financial capability to do that, or if you don't have the confidence to do that over the mid to long term, then of course that would then cause some distress. So you must make sure that you have that financial capability to maintain the monthly installment. But there again, because of the 8 different characteristics, you can always rent it out. Let's say, for example, something happened. You're unable to service the full amount. You can always rent it out, make different kind of, let's say if it's an investment property, you have already been renting it out. And of course, if let's say interest rates do rise and the mortgage does increase, you must make sure firstly you have that ability to top up that difference from... Sorry, that's my wife. Because it's 7:30 p.m. right now at the point of filming. Mr. Daniel is here with me. He haven't ate his dinner yet. I gotta finish fast, all right? Yeah, so because of the inherent characteristics, you also have flexibility to do different things. Let's say, for example, if let's say you're occupying your property now, and you really need to hold on to your property, you can choose to rent it out and you can choose to generate income with it, provided you have an alternative accommodation to stay maybe with your parents and things like that. But there's always options to think about how to hold on to the property. I think the most important thing is that at the point of purchase, you must have that prudency to set aside a range of monthly installments, at least for the next 6 to 12 months, just in case if let's say you lose your job or maybe your business suffered and things like that. And the second criteria is that you must have a confidence that you're able to hold for the mid to long term and a bare minimum of 3 years so that you do not have to sell a property in distress over the seller stamp duties period. So with that taken care of, then I think real estate is a beautiful investment because of these characteristics and because of the ability to ride on inflation. Now, the other side of your portfolio definitely, I think, should be balanced out with more liquid assets. All right, and I'll leave that to you consulting with your different kinds of experts, whether is it stock investing, whether is it different kind of funds investing and mutual funds and things like that. We'll leave it up to you. To end off, in summary, the key takeaway from today's episode is that asset inflation is very real because sometimes we are just being looking at that CPI inflation of 2%, which does not include real estate fundamentally. So very importantly is that if you have the capability to invest, do plan your portfolio early. Do not wait out for too long because we're in Singapore. We're not in other countries where we have vast areas of landscape to build more and more properties. Our land is extremely limited and our population is continuing to rise with a target of 7 million according to white papers by 2030. And we are so limited in the sense that no matter how many forests we clear or we continue reclamation, I think our land is extremely limited. So I think the most important thing is that Singapore is also becoming a very, very strong financial hub. After the pandemic, a lot of family offices have set up here. A lot of hedge funds are coming in. A lot of liquidity are flowing to Singapore. Singapore is also cryptocurrency friendly. This is a new season, I think, for Singapore. Though there might be financial turmoil happening on and off in other parts of the world and we are connected globally, But I think fundamentally is that if you have not invested in your first property, it does have importance to plan that early on. Or let's say if you have additional liquidity to invest and you're looking for a safe haven, then I think you can do more homework. You can also look at our YouTube channel as well as our PropertyLimbrothers Insights page on PropertyLimbrothers.com to look at some of the articles that we have and research that we have. And we hope that this episode will help you in your investment journey. And once again, my name is Melvin. Thank you for staying tuned with us on Nuggets on the Go. We'll see you on the next episode. In the meantime, take care. Hey, sorry. We need to look at sorry, Marilyn.